There are a lot of variables to consider when selecting a lender for your next investment project. While many investors focus on the basics, rate and term, these aren't always a good indicator of the most important aspects of the loan. In today's Hard Money Minute, I'll discuss some often overlooked elements that you might want to consider. But everything starts with the project. If you've talked to me on the phone or you've watched some of my other videos, you may have heard me use the analogy of the tool shed. Think of all of your finance options as tools. And then imagine that all of those tools are stored in the shed in your backyard. When you have a project, you go to the shed and you pick out the best tool for the job. Sometimes you need a hammer, other times you need a drill or a saw. Choosing the wrong lender for your project can be like choosing a chainsaw to change a light bulb. It won't work very well and it's likely to get you bloody. Since I've already mentioned rates, you should know that the interest rate is going to vary greatly from lender to lender. If you have a ton of experience and pristine credit and you've got plenty of cash to put in the deal, you can find a lender that's going to be as low as 7 or 8%. There are also companies that are going to charge you 15 to 18%. The average is probably going to range somewhere between 10 and 14% depending on your specific situations. Speed can be a very important aspect of any loan. How fast can the bank close? There are times when speed is paramount. Motivated sellers, they want to close yesterday, and solving their problem can mean big discounts. Unless you have a pile of cash sitting around, you're going to need a lender who can move quickly and fund as soon as the title is clear. In other circumstances, there's no feet to the fire. You don't need to go to closing yesterday. You have plenty of time for a funding source that might involve some additional paperwork or just take some extra time. Generally speaking, hard money lenders are going to be much quicker than a traditional residential or commercial lender. But with more and more companies using bank and institutional money for their loans, appraisals and underwriting can be the difference of weeks or even months. Another variable that you should consider is the term or the length of the loan. What you'll generally encounter are loan terms ranging anywhere from 6 to 24 months. If you can get in and out of a project quickly, then a short-term loan is going to be to your advantage. If the renovations are really extensive, or maybe the project involves rezoning, then be sure to select a lender with longer terms, like 18 months, 2 years. Right now, what I see a lot of talk about OPM, using other people's money. While high leverage might be in vogue right now, remember that you'll be paying interest on every single dollar you borrow. There's nothing wrong with putting your own cash in a deal, especially when you're confident in the project and in your ability to perform. But if OPM is what you're after, know that lenders vary greatly with the loan amounts and the calculations. Advertised and even quoted terms aren't always what they seem. I've seen competitors quote my clients high leverage on a loan with very little cash to close. Most of the time, the quote is contingent on an appraisal. When the number finally comes through, a lot of borrowers are asked to bring thousands more to the closing table than anticipated. Rate and term are important when selecting a lender, but they're not the only variable to consider. Weigh all of the costs before you choose a funding source for your next loan. No one would grab a chainsaw to change a light bulb. Choose wisely. Make sure the lender on your next deal isn't going to leave you bloody.